An SMSF will be tax-free in retirement, whereas a trust or a family trust or any type of trust will be taxed at the marginal rate of whoever's receiving those funds. With a trust, it is a completely different structure. The main difference is you can access those funds whenever. You don't need to reach preservation age or retire to be able to access those funds. Who is an SMSF best for? It's best for those that are welcome to SMSF Insider, where we help busy professionals to gain financial independence using an SMSF. Hi, I'm Troy, founder of Blue Chip SMSF Services, and over the last 20 years, I've helped thousands of Aussies manage the complexities of self-managed super funds. And in this podcast, I'll answer your questions, break down the myths, so you can take charge of your financial freedom. Let's get into it. Hey guys, just a quick disclaimer and just a reminder that this is not personal advice, so make sure you speak with a licensed advisor before making any investment decision. Hi, welcome to SMSF Insider, and today we're going to be talking about self-managed super funds versus trusts. So they're two different structures. So an SMSF is typically a structure that is used for retirement purposes only, and you can't access those funds until you have reached preservation age or you meet a condition of release. And when I say condition of release, you need to, one of those is retirement. Another one of those is total and permanent disablement, and financial hardship, and there is one more in there. But those are the conditions of release that you must reach before you can access any of those funds. But the main one is, of course, retirement and reaching preservation age with an SMSF. With a trust, it is a completely different structure, and the main difference is you can access those funds, whenever. You don't need to reach preservation age or retire to be able to access those funds. And a lot of people will have both. So some might have an SMSF and they might have a trust in addition to that. So with a trust, it's typically like a family trust. You hear this a lot, and it is, and typically it'll be what's called a discretionary trust. And what that means is that trust has, or you have discretion about who your beneficiaries are, or who can access those funds. So you might have a family member that's on a lower tax bracket. You can distribute that income to that lower that family member that's on a lower tax bracket, and they can receive those funds, and you can essentially decide who those funds go to. Whereas an SMSF, obviously, the funds are only limited to the members of that fund, and you can't access them to reach preservation age. So with the family trust, you can obviously access those funds before retirement. And they do have some different tax implications as well. So an SMSF will have it'll be tax-free in retirement, whereas a trust or a family trust or any type of trust will be taxed at the marginal rate of whoever's receiving those funds. So the discretionary trust, if that income is being distributed to one of those beneficiaries, or one of the members of that, or the beneficiaries of that trust, I should say, then it'll be taxed at their marginal rate. So if they're being taxed at 30%, that income will be added on to their current marginal tax rate. So if they're earning $100,000 a year and $50,000 is distributed to that member, or that beneficiary, I should say, their income is then taxed at $150,000. So whereas with an SMSF, you can't do that. That income remains in the SMSF and stays there until retirement. So they are two very different things, and I would suggest certainly reaching out to your accountant or your advisor when it comes to setting up a trust, and do you actually really need one? If you're in business, then perhaps a trust might work for you, or you're purchasing assets outside of super, potentially a trust may work for you, but certainly reach out to your advisor or your accountant to get some advice on whether you actually need one. But they are certainly two different, very different structures, and with an SMSF, you'll need more than $200,000 in that fund before it becomes sort of worthwhile having one. Whereas a trust, you can have under 200,000. You can have there's no minimum on how much you can have in a trust as opposed to an SMSF. So they are two very different things. The two main differences, one is for retirement and one is for when you're in accumulation phase and you're acquiring assets outside of super. That is typically the structure that most people use. So reach out to your advisor or accountant about whether or not those structures are right for you. Just quickly, guys, if you're a busy professional, fed up with traditional super funds and overwhelmed by the setup of your SMSF, we can help. Book in a call with my team using the link in the show notes and let's build your future on your terms. Now, back to the episode. So who is an SMSF best for? It's best for those that are building wealth for retirement, those that want to invest in property, and that might be business, real property like office, industrial, commercial, or even residential, or alternative asset classes like crypto, for example, and people with more than 200,000 in super to justify the costs. Benefits of having an SMSF, obviously full control over your retirement savings, and of course the tax advantages of 15% being the maximum tax rate you'll pay. And then it tapers down from 15% to 10% if you've held the asset for more than 12 months, and then all the way down to 0 if you have held the asset all the way through to retirement. So in pension phase, earnings are on withdrawals are tax-free. So if you don't sell the asset, the income that asset generates will be tax-free. And of course, the ability to use gearing with an SMSF is something you can't do with any other super fund. So that is a really powerful tool and certainly a huge benefit when it comes to establishing a fund and getting exposure to assets. Having that gearing can make a huge difference to your long-term gain. SMSF is a great estate planning tool as well. So you can obviously distributing to your beneficiaries later on in life when you're wanting to separate assets, and you've got your will, which will cover off your assets outside of super, and then of course your binding death nomination, which will nominate your beneficiaries for all your superannuation assets. The limitations with having an SMSF or just super in general is the money is locked away until preservation age typically. So it is a long-term strategy and so the money is locked away for retirement. So you can't access it, immediately like you can with a trust, but certainly for long-term planning or retirement planning, it is a good tool or a good structure to use. It does have strict compliance, and so you do need to have an annual audit and a tax return done every year, which your administrator should be doing for you. And it's not quite as flexible as a family trust. So as I said, there are some limitations and restrictions around having an SMSF, but most of those can be outsourced to your SMSF administrator to make the job easier for you. Which is better to invest with. If your goal is retirement savings, then certainly the SMSF wins. You get the super concessions, or the tax concessions, I should say, being obviously a very low tax environment. That's it for this edition of SMSF Insider. If you've got any questions or there is something you'd like us to talk about, please drop some comments in the comment section below. Thanks for tuning in. Thanks for tuning in to this episode of SMSF Insider. If you got value from this, make sure you subscribe so you never miss the strategies we share to help you take control of your financial future. Find us on socials at Blue Chip SMSF or book a call with our team to see if we can help you.